Hello everyone, welcome back to Stanchain Crypto. Last week, we told you the market was compressed, Bitcoin was moving sideways, volatility was low, open interest was climbing. The market was waiting for a catalyst. Well, it finally got one. Bitcoin pushed back above $65,000 this week, while Ethereum and several major altcoins started moving with it. But Friday gave us the biggest surprise. The United States just released its July jobs report, and it was nowhere near what the market expected. So forget the noise for a second. Forget the people screaming that Bitcoin is going to the moon. This week gave us something much more important, a reason for the market to move. And that's where we start. The U.S. economy was expected to add around 80,000 jobs in July. Instead, payrolls fell by 23,000. That's not a small miss. That's a massive difference between what economists expected and what actually happened. Unemployment came in at 4.1%, and previous employment numbers were revised lower as well. Bitcoin immediately reacted. It pushed above $65,000 as traders started reducing expectations for another Fed rate hike. And this is where people make the stupid mistake. They see a weak jobs report and immediately say, bullish for Bitcoin. Not so fast. A weaker labor market can give the Federal Reserve more room to ease monetary policy. Lower rates, more liquidity, more appetite for risk. That's obviously good for crypto, but there's another side. If the economy is weakening too quickly, that's not bullish. That's a warning. So the real question isn't, are bad jobs numbers good for Bitcoin? The real question is this enough weakness to change the Fed's behavior without creating a bigger economic problem? That's what we're watching. Because last week we said the Fed hadn't given crypto the green light. This week, that light just got a little brighter. Now let's move from macro to Washington. The Clarity Act was supposed to be one of the biggest regulatory developments of the year, and the deadline was basically here. But the Senate didn't get it done. The vote has now been pushed until at least September because lawmakers couldn't reach enough agreement to move it forward before the August recess. And here's what makes this interesting. The crypto industry has been waiting for regulatory clarity for years, so you'd expect this delay to crush the market. It didn't. Bitcoin kept moving. The market basically shrugged. And that tells us something, my friend. Right now, macro is commanding more attention than Washington. That's important, because eventually, regulation can become a massive catalyst for crypto. But today, the market cares more about liquidity and the Fed. And if the jobs data continues weakening, Washington might not be the thing driving the next move. Now here's another piece of the puzzle. Bitcoin ETFs just had a strong run of inflows. US spot Bitcoin ETFs recorded 4 consecutive sessions of net inflows through Thursday, with more than $760 million coming in across those 4 sessions, according to reported fund flow data. And Bitcoin pushed back above $65,000. That doesn't automatically mean we're starting another massive bull run. Don't get carried away. But it does tell us something useful. The move isn't happening in a vacuum. There's actual spot demand behind it. And that's much healthier than watching Bitcoin pump purely because leveraged traders are gambling with each other. If you want signals like this for free, follow me on X and stay in tune with the latest trends and news in the crypto world. I post some of my intentions and trades every day, so if you feel capable of taking a beating from the market, get in. Now here's the part I think most people are missing. Look at the sequence. For weeks, Bitcoin was compressed, low volatility, rising open interest, everyone waiting for something to happen. Then we get a major macro surprise, and suddenly Bitcoin moves. That's exactly what we were talking about last week. The market wasn't dead, it was loading. But here's the important part. We still don't know whether this is the beginning of a real trend. or simply the first liquidity grab before another move in the opposite direction. That's why we're not celebrating a $65,000 Bitcoin like it's the end of the cycle. One breakout doesn't prove anything. The next question is whether Bitcoin can hold the move, because anybody can pump a chart. The real test is what happens after the excitement disappears. So let's check last week's prediction. We said low volatility combined with rising open interest was setting the market up for a major move. And this week, we finally got movement. The prediction wasn't that Bitcoin would magically explode on Monday. We even suggested for a deeper drop after taking the upside liquidity. The prediction was that this compression wouldn't last forever. And now we're seeing the first signs that it didn't. So what's our outlook for next week? We're cautiously bullish. That's why we are with the green t-shirts today, But we're not chasing. If Bitcoin holds above the breakout area, ETF demand stays positive, and the weaker economic data continues pushing rate expectations in a more supportive direction, then this could develop into something much bigger. But if Bitcoin loses the move, and leverage starts building aggressively again, which is highly possible, especially after a light in the tunnel, we could be looking at another trap. That's Stanchain. We're not here to scream, buy, every time a candle turns green. We're watching what happens after the crowd gets excited, because that's where the real information starts. And remember, if everyone already agrees, you're probably too late. We'll see you next week.